wouldn't it be nice if a savings account gave you 20% return on your money for just putting it in an account? Well, Terra Labs might have finally done it with Anchor Protocol that has been paying a 20% return on your money on stablecoins for over a year now with no plans to stop it.
Yeah, boy.
So, I think it's time to go over how it's actually possible that they're blowing every other exchange out of the water with these insane returns and see if it's actually sustainable or not, and see how you can start making money with it as well. Yo, what is up guys? It's your boy Forrest, and in today's video, I'm going to be going over the savings protocol that's been getting a ton of buzz lately called Anchor that's been paying people 20% APY. Now, obviously there's no such thing as a free lunch, so I want you guys to understand what's really going on before you throw your money into this platform. So I'm going to go over what Anchor is, how it's making all this money, the risks associated with it, and the future of this platform. But before we get into the video, if you guys want to earn crypto just for signing up, Coinbase gave me a special link where all you have to do is sign up and you guys will get to earn crypto. Now, if you guys want to take part of this, I'll leave a link to it down in the description box below. Also, while you're there, make sure you guys smash that like button, subscribe if you guys haven't already. I make videos all about money, finance, crypto, all that good stuff. So if it is something that interests you guys, make sure you guys subscribe so you don't miss out on any future videos. Okay, so what is Anchor and how does it already have $14 billion in total value locked in just 1 year from launch? Well, simply put, it's a decentralized savings protocol that is paying you close to 20% to lend or give them a stable coin called UST. And I know what you're thinking, 20%? That sounds way too good to be true, and you're probably right, so let's dive in. Alright, first, in order to understand Anchor, you need to understand what Terra Labs, the team behind Anchor, has built with this revolutionary stablecoin blockchain. Essentially, the founders are these really smart dudes from Stanford and Wharton that saw a huge problem in the stablecoin space, which is all these stablecoins you see today. So USDT, USDC, and BUSD are all controlled by centralized companies, meaning these companies can essentially do whatever they want with your funds, and if one day the government orders them to freeze your assets, they theoretically can. Which essentially goes against why crypto was created in the first place. It's meant to be decentralized and not owned by anybody. To solve this problem of companies having too much control, they created UST, their stablecoin, and Luna, its native token. Now, these two coins work with each other as a burn and mint mechanism to algorithmically keep UST pegged at just $1. So let me break this down even more. So let's say you and I own Luna and a bunch of people start buying UST. This is going to increase the price and push it over $1. And if you're thinking about this, that's bad, right? We want a stable coin to stay the same price, hence the name stable coin. Well, here's where the magic happens. Terra's protocol ensures its users can always trade $1 of Luna for 1 unit of UST. So if me and you own Luna and we saw that UST is trading at $1.01, we'd go ahead and swap our Luna for UST and pocket that 1 cent difference. What's going on in the background is when we swap our Luna, it actually gets burned and thrown away into the crypto galaxy, and then UST is minted for us. So if our economics courses have taught us anything, we know that when supply increases with no other external factor, this causes the price to go down, which is exactly what's going to happen to UST, meaning it's going to go back to the $1 stablecoin price point. So these two pools feeding off each other with the mining and burning of each coin, it helps the coin stay at a stable price, which is really cool if you ask me, and super unique. So now that you know about the Anchor protocol, I want to drop some numbers on you guys. Boom. Anchor currently has $8.3 billion in deposits and is currently paying around 19%, meaning Anchor is expected to pay around $1.6 billion this year. So how the heck are they going to do that, and where's all this money coming from? Well, Anchor makes its money in a few different ways. One is through the collateral that they get from the loans that they lend out. Every loan someone takes out on Anchor must be over collateralized, meaning you have to put up more or give them more than what you're borrowing in order to take out the loan. Along with the income that they get from lending to borrowers, they also take this collateral and stake it to make themselves even more money. So if I do some quick math to see how much Anchor is earning from their staking and borrowing income, it comes out to $783 million. And remember earlier in the video how I said they need to pay out $1.6 billion this year? Well, here's where the problem lies. See, Anchor used to have more income coming in than it was paying out, and it would put this money into something called a yield reserve, which you can think of as a big vault holding a lot of money, which is their stockpile to help them in times when their income is less than how much they need to pay out to meet that 20% threshold. Well, now that Anchor has gotten so big, the income they have coming in can't cover how much they need to pay out. So from these numbers, Anchor is currently sitting at an $816 million deficit. So that means they're pulling money out of this reserve every day to keep that 20% alive. And Anchor actually already pulled out of this reserve twice, $70 million back in July and $470 million just last month. What's even crazier is 2 weeks ago, they just announced that since the reserve is drying up so quickly, the Luna Foundation Group, so the investors behind Terra, are putting $1 billion worth of Bitcoin. Yes, $1 billion into the Anchor Yields reserve to keep that 20% APY alive. And they say this will allow Anchor's APY to sit at 20% for another year or so. Now, I know what you're probably thinking right now. Why the heck would investors be willing to do this, as it's a long-term play that may or may not pan out? See, Anchor and his investors know that once this reserve starts to dry up after that $1 billion, it's going to have to reduce the APY because obviously they just can't have that going on forever or else they'll go broke. What I'm thinking is investors are hoping that Anchor will accumulate a ton of users over the next year, and when Anchor starts to drop the percentage return, people will have gotten so accustomed to the platform and will still want the passive income even though they aren't getting paid as much. So they'll keep their money in the protocol because they're just so used to everything. Then eventually Anchor will drop its APY to a place where they'll have more money coming in than going out. And at that point, the team and investors should be making money from the project. But this bet only works if users stay as they keep lowering their percentage returns. And what from investors are saying, it looks like that's going to be the case. Now, these returns sound really nice, and with Anchor getting really hot, you need to know the risks that come with it, especially with stablecoins. Now, the biggest downfall of Anchor would be UST losing its peg, meaning not staying stable at $1. When there's a lot of market stress and selling pressure in crypto, which I think we all know there is, it puts a lot of strain on the Luna and UST burning and minting mechanism, because when both are experiencing sell pressure, it's hard for it to hold its peg at $1. If we look at the all-time chart of UST, it had 2 periods where it briefly lost its peg then rebounded. The worst thing that can happen is if the price doesn't rebound and it spirals all the way down to $0, because that would destroy the whole entire protocol. Now, I don't think this is very likely to happen due to the backing UST now has and the daily limits on how much Luna can be minted, but with crypto you never really know. Over the past 3 to 4 months, you guys know the crypto market has just sucked, and UST actually performed really well and didn't deviate from its peg, which gives me confidence that the technology behind Terra is really working. Another risk that could be really vital to the protocol would be a bug in the code. Now, since DeFi runs on smart contracts, if a hacker figured out how to exploit Anchor, theoretically they could steal a ton of people's money, just like what happened with Polygon with their $600 million hack. Nonetheless, having bugs is a risk all crypto projects face, and the CEO of Anchor said if anyone can find a bug that allows them to take $50,000 or more, he'll personally give them $1 million as a reward for finding it, which is 1, a total baller move, and 2, shows how confident he is with Anchor since there's been like $14 billion worth of hacks just last year alone. One thing to note with these risks is that Anchor does offer insurance for 7% of the APY through a third-party provider if there was some huge hack and you lost all your money. But I just caution you to remember that everything in crypto is highly unregulated, and even though there's an insurer, can you really ensure that you're going to get your money back if it all gets stolen? There's $8.3 billion deposited in Anchor, and I'm not so sure this third-party insurer would be able to cover even a small percentage of that. So just keep that in mind if you're looking to have your funds insured. So what's the future of Anchor, say 2 to 5 years down the road? Well, there's this really cool article written by Ryan, which I'll leave down in the description box below, who estimates Anchor's medium and long-term APY. And he thinks in the short term, so by 2024, Anchor's APY will have dropped to around 6.8%, a drastic change from today's 19%. And in the long term, he sees it sitting at around 4.8%, which in all honesty is still a heck of a deal if you're comparing this to your savings account that you get from your bank that probably gives you like 0.02% return on your money every year. So if you wanted to make $1,000 a month from Anchor at today's rate of about 19.44%, you need to put up around $61,700. So if you guys are interested, I would suggest doing it as soon as possible because these rates won't be here forever. Overall, I think Anchor could have a really bright future as one of the top decentralized savings account out there that a lot of people can use and earn money from. They just have to figure out a way to get past the selling pressure that they experience when yields start to fall. Like I said, I think this is a really cool project and I'd really like to see it succeed in the future. But as always, do your own research before you invest, and let me know what you guys think about Anchor and its future down in the comment section below. Also, if you guys are interested in buying crypto, I suggest checking out crypto.com. They have all the top cryptos you guys would ever like to buy. So if you guys are interested, I'll leave a link to that down in the description box below as well. But I really do hope you guys have a great rest of your day, and I'll see you guys in next week's video. Peace.